Thank you so much, Olivier, for that very powerful account of the ALSF's work and the impact of our operations on the continent. As introduced, my name is Victor Oje. I'm legal counsel at the ALSF, and I work closely with Olivier and Nicole Kiers, who is the head of sovereign finance at the ALSF. Good morning, distinguished ladies and gentlemen, and honorable members. So, building on Olivier's speech about the ALSF's work, I don't think I will need the screen because a lot of my remarks will be from my personal computer. Do I need to turn this off, or is it okay to just be on the screen? I would share my presentation afterwards if that's okay. I don't intend to project it. So we're building on Olivier's speech for over the next 35 minutes or so, and I would like to take a broader view into this question of sovereign debt restructuring in Africa, and to the best extent that I can, trace how or where we came from, how we are here, and how we are dealing with the common framework. The reason why I'm adopting this approach is so that, as our elders would typically say, in order to understand where you are, it's necessary to look at the past. And that's what we're going to do. We're going to look at HIPIC, we're going to look at the MDRI, we're going to look at the DSSI as well, and then we will come to the common framework and try to find a way by which African governments can not only negotiate and take advantage of the common framework, but also provide for themselves the kind of results that will make their impact scalable in their own respective countries. Towards the end of my remarks, I will try to look at, again, the work that the ALSF is doing and to make some accents on some of the very specific projects that we've worked on and how we have been built and positioned to assist you and support the African governments in sovereign debts and sovereign finance more generally. 5 years ago, just during my master's program in the United States, one of my professors who took me a course in international economic law, I like to think he's what you might term the doyen of sovereign debt restructuring from a legal standpoint. He said something that changed the way I view debt restructuring. He said, sovereign debt restructuring is not a failure of policy. Prior to that, I always thought it was. I thought, if you have to restructure your debt, it's because something failed in your policy, or in your governance, or in your politics. But he said, and this is someone who has restructured single-handedly the Argentinian debt, restructured the Greece debt, and restructured over 24 debt restructurings across the world. He said it's not a failure of policy, but a feature of the international financial system today. It is not designed to punish creditors, but to return a country to sustainability. That is what we are discussing here today and for the rest of this week. And so before I begin in full, my hope is that by the end of these reflections, and I promise not to go beyond 35 minutes, you will carry away a clear sense of how Africa's sovereign debt journey has unfolded from the very earliest times, like I said earlier, to these particular points. I'm cognizant that the G20 Common Framework is the focus of this discussion, but like I already mentioned, I want you to remember that Africa's debt story did not start from the G20. It started in the 70s and in the 80s, when I was not even born. So during that time, many African governments, reeling from, as you know, recent independence from colonial rule, were very keen to develop their countries, to have infrastructure projects. And so, like the biblical story goes, they went a borrowing. And between the 70s and the 80s, African countries had borrowed from over $11 billion in debt exposure to over 120 billion US dollars. Unfortunately, as I'm sure many of you here would recall, this boom was derailed by global setbacks. We had the oil commodity shocks of the 80s, there were rising interest rates, there were governance issues, tons of political instability across the continent. All of these factors cumulatively led to what we now know today within the restructuring world as the global debt or African debt restructuring saga of the 80s. And so as these debts mounted in the 80s, the international response was very specific. Most of the debts were owed either to Paris Club members, the 22 NATO plus G20 members, and London Club members who were mostly international banks at the time. And their response was, we will reschedule your debts, but we will not cancel. And as one scholar put it back in the day, the restructurings at that time, which are mostly just reschedulings, were sometimes or most times a little too late and a little too insufficient for the sovereigns. By the mid-90s, it became clear that Africans or African countries, and more generally indebted countries, needed more than just rescheduling. And I hope you know by rescheduling I mean postponement of payments. More than rescheduling of those debts, they needed a more concrete structure or framework to attack the debt milieu of the time. And so by that time, HIPIC was launched. HIPIC is the Heavily Indebted Poor Countries Initiative. And the aim of HIPIC was that countries would be able to have write-downs of their loans. You owe 100 billion US dollars. HIPIC could ensure that you have 100 billion? 80 billion. Oh, my maths. 80 billion written off on that basis. And HIPIC was swiftly followed by the Multilateral Debt Relief Initiative, which I will now call the MDRI for the purpose of this conversation. In combination, you can imagine, 100 billion US dollars was wiped off in Africa as of 2005, with some countries still working hard to reach the HIPIC decision point. Well, the impact on debt sustainability was dramatic, as you can imagine. After HIPIC and MDRI, GDP ratios fell dramatically. Uganda's debt exposure fell from 60% to just under 30%. Nigeria had one of the most historic and dramatic outcomes from that process. Nigeria secured, I believe it's a $18 billion wipe-off or write-off of debts under HIPIC and MDRI. Yet, I know you're waiting for the yet, and here it is. Well, these gains came with a very cautionary tale, very cautionary lesson that says debt relief must be matched with prudent fiscal policies. And I will come to why that's very important later. So that we saw that countries that maintained legal and fiscally prudent measures did not only thrive through the HIPIC and MDRI initiatives, they also survived the more bitter years of the early 2000s when the global economy was in shock. And so after HIPIC and MDRI, as little children with sweets in their mouth, some African countries went back to the capital markets, this time with renewed fervor. They had better credit rating, their debt to GDP was very low, and they could access and tap into more nuanced markets, like the Eurobond markets, and, as you could expect, newer players in the bilateral bloc, China and India. And so between 2008 and 2018, African countries again ranked up debts to 583 billion US dollars, much of which was on shorter terms and on less concessional basis. And by implication, it meant that those debts were very expensive. And so when it's time to pay back, you're paying back far more than you originally took on. Unfortunately, the turning point came in 2020 at the advent of COVID-19. By this time, Africa's debt has ballooned to, yes, you guessed it, 1.8 trillion US dollars. Of course, the COVID-2020 pandemic ushered in many new defaults on the continent, many that had not happened before. And what we saw was that just a decade after significant relief, African countries seem to be back to the negotiating table. And this ties back to the point I made earlier, that debt relief without fiscally prudent measures do not do the magic for any economy. And so in 2020, the G20, so we're getting home now, how the G20 started and where we are today. So it was in 2020 that the G20 realized, many countries cannot pay their debts, most of whom were African countries. And so to help countries cope, the DSSI, which is the this debt service suspension initiative was launched in 2020. And the idea was that service payment on debts, as you'll be aware, every country yearly have an amount dedicated to debt service. The idea for the DSSI was that this service will be suspended for a determined period. And so the initiative achieved some considerable relief, and some countries, had to channel more funds into healthcare and other social development needs and requirements of their countries. Nonetheless, the initiative, that's the DSSI, did not achieve one thing. Or it did accomplish one thing, I beg your pardon. It forced all creditors to come to the negotiating table. And for the first time in a debt restructuring architecture, we could see not just Paris Club members, but bondholders to a lesser degree under the DSSI, and non-traditional lenders like China and India. Think about, not consider, but think about the possibility of participating in restructuring. And you remember from the beginning of this speech I'd said, restructuring itself is not a failure of fiscal policy. It is a feature of the international financial system. And so, owing to the failure or the shortcomings of the DSSI, as well as the success of the DSSI, now that we realize that, for the first time, all lenders can come to the table, the G20 launched the Common Framework in November of 2020. And this was a significant evolution. First, of course, was the fact that we had all creditors coming to the table to discuss, and this included China, India, Saudi Arabia, etc. But also that debt restructuring could be a less messy ordeal, that all parties could discuss on equally favorable terms what can be done about their debts, about a country's debts. And so, in practice, the framework applies to countries with unsustainable debts and who were adjudged eligible under the DSSI, and these are generally IDA, as international development agencies, categorized low-income countries. So how does the framework work? In a couple of days, we will deal with sovereign debt restructuring more broadly, and I will have the privilege to walk us through some of the elements of sovereign debt restructuring and how it works. And so on that basis, I will not go into depth as to how the common framework works, but fundamentally, you typically progress from procuring an IMF program and then move to arranging an official creditor committee. And this official creditor committee more or less organizes the creditors, comes to a memorandum of understanding with the government, and when that is achieved, you seek comparable treatment, whatever agreement is made, with other creditors, and that includes bondholders. Has African countries been involved in this mechanism at all? It's been launched for the past 5 years. And earlier today, we heard the Honorable Deputy Minister of Finance in Ghana refer to some of the countries who have actually engaged the common framework. He talked about Chad, Ethiopia, Ghana, and Zambia, all having varying results and varying experiences on debt restructuring under the common framework. I have my views, but I will not share them today. When you come on Wednesday or Thursday when we talk about debt restructuring, you'll hear some of my views. And so, all countries who needed or who need to restructure their debts now have this veritable platform of common framework to negotiate with their lenders. But countries have approached the common framework with mixed feelings because they've been through it. They've been through the London Club. They've been through the Paris Club of the 90s. They've been through the EPIC and the MDRI. Some of them have been through the DSSI. And so there's a sense in which, as you can imagine, they would consider the G20 with some suspect. And so whilst Ghana and a few countries have taken the bold step, others like Malawi have taken another route, and I will come to that a bit more later. So if you're wondering, if a country does not want to use the G20, how does it go about restructuring its debts? Sri Lanka offers some perspective. In 2022, Sri Lanka defaulted. And because, as I already mentioned also, the common framework works for certain countries. Certain countries so are judged as eligible. Sri Lanka, unfortunately, was not determined to be one of those eligible countries because they were a middle or considered a middle-income country. And as much as you don't believe it, there are some African countries who are currently ineligible for common framework treatments. But Sri Lanka was one of the countries that gave us perspective as to what can happen in these days. Previously, we have the fragmented creditor base, where different creditors had different approaches to how they wanted their debts to be dealt with, but then the common framework brought a unifying factor. And so when the country is not eligible for common framework, what happens then? The good thing is that even without the common framework, you can take advantage of the principles of the common framework, get all creditors on board, constitute an official creditor committee, and have them and negotiate with them to create a lasting agreement on what amount of debt can be restructured and who can take what and who must lose what. Another case on this point is Suriname, and Suriname also is a country outside of Africa that did not use the government framework but restructured or is under the process of restructuring its debts using the same principles of the common framework. Get all the creditors together, have an official creditor committee, and sign an MOU. Malawi, which I mentioned just a couple of minutes ago, is an African country not ineligible, under the common framework, but refused to use the common framework for varying reasons. One of such reasons being that a lot of Malawi's exposure was to multilateral banks. And as you probably know, the international multilateral banks, some of them have what we call the preferred creditor status. That's been in the news for a while now, in the past couple of weeks. And I wouldn't delve into that, not in this conversation. And maybe during the week we would discuss that. But because the creditors have preferred creditor status, Malawi cannot effectively subject them to common framework restructuring principles. And so, on some level, officials in Malawi determined that perhaps the common framework was not necessary to deal with preferred debts. What these examples of Sri Lanka, of Suriname, and of Malawi show to us is that, for one, debt restructuring is far more coordinated today than it was in the 80s and in the early 2000s. But secondly, non-Paris Club members, for the first time, can now jointly with Paris Club members and bondholders, well, initially without the bondholders, but we'll come to the niceties later, agree on a debt treatment for a country. And third, that a country can make use of the principles of common framework, including official creditor committees, comparative treatment for holdouts, and innovative instruments like VRIs, value recovery instruments, without needing the common framework, strictly speaking. I know that I've spent at least the last 15 to 20 minutes talking, so I'm going to try to round off in the next 15 minutes or 10 minutes. So what lessons does this journey, all of this grammar that we've been disquisiting on this podium, what does it hold for Africa? Where do we stand with the common framework? The very first lesson is postponements are not solutions. When debt is postponed, it doesn't really work for the country, because what it means in effect is that you exclude today for tomorrow's treatment. It doesn't do anything to necessarily help the debt stock of that country other than a temporary relief that is, you may say, unsustainable on some level. The second lesson we've learned as a continent, or we should be learning as a continent, and this is perhaps even more important, is that relief must tie to reforms. We are in a very specific inflective moment in history where there's a huge push for a global framework for debt restructuring, and rightly so. There are calls for reparations, there are calls for restructuring the restructuring framework. But also, we must look inwards as a continent to foster practices that emboss fiscal prudence to sustain whatever relief we get from this recent clamor. Third, and very related to this previous point, is building strong institutions. No country grows better or beyond its institutions. And fourthly, coordinate and share the burden. Zambia and Ghana were countries who, for very good reason, needed to exclude certain debts in order to preserve, for example, the local economy. This didn't work in both cases, but the idea is creditors want to know that if you would call them to the table, you're willing to share the burden. And finally, on this point of lessons, is that legal preparedness is crucial. And this is the point where I'll bring back the ALSF in a second, but this is extremely important. And the reason why is because our experience has shown that where we do not look at very fine prints of debt contracts, of bond indentures, we risk running into debt problems in the future. Carefully worded collective action clauses that allow holdout creditors, or that compel, quite frankly, holdout creditors to come to the restructuring perimeter were introduced because one fine lawyer thought the only way Greece can go forward in its restructuring is if we bring holdouts into the perimeter. And so in 2008, as my director had said earlier, the ALSF was established to combat what we knew then as vulture funds, who would buy African debts from their creditors, hedge funds mostly, and try to get the amount times 100 or times 10, if you like, from the African governments. And one of the core mandates of the ALSF was to use a strong word, combat head-on some of these vulture funds, quite frankly, as they were called, in order to ensure they don't rip off our continent. And this worked. This worked in DRC. And I wouldn't go into the niceties of that. I will share my notes later. And so, in more than just the niceties of the contracts that the ALSF assists with dealing with, the true brilliance of the ALSF's impact is even beyond just the contract, and it moves to actual hand-holding together with very competent advisors that we recruit to work with to assist the government in negotiations of debts, but also in restructuring of debts. And we are working on tons of countries right now. My director showed you Zimbabwe, for instance, which is a live case, Somalia, which is also a live case to a certain degree, and a few other countries like Lesotho, etc., that we are working currently on clearing their arrears and undertaking their debt restructuring. In some of our member states and member countries whom we've received requests from, we've assisted with developing a scenario-based capacity building for medium-term development strategies. We've assisted with developing annual borrowing plans and reviewing the ones that are available. We've overhauled whole contracts entered into between governments during a restructuring scenario in order to ensure that the terms are fair and represent what is equal and equitable under the current architecture. Beyond those, the ALSF also provides and produces ongoing materials. Currently, for instance, my director mentioned knowledge products that we are working on, and I will just deep dive into one of the products. And it's an annotated loan guide that spells out every term you would encounter in a loan agreement between a sovereign and a lender, especially the problematic clauses, and aims to tell you first what the lender is looking for, and second, how to negotiate those clauses in favor of your government. The document is still being produced. We're looking across the bond and loan spectrum. So it's a holistic document that's coming out very soon. Apart from that, we have a debt guide on development swaps. We have a debt guide more generally on sovereign finance and a couple of other knowledge products. One ambit that is perhaps sometimes overlooked is, and like my director said, our mandate is to ensure that African governments can sit across from the IMF, for instance, sit across from Citibank and HSBC and all of the big banks and creditors you know, and be on equal footing in negotiating or restructuring a loan or bond indenture. The idea is simple. If we are on equal pedestal, we can get equally measurable, productive results for each party. And so these are some of the impact areas that we've had on the continent. We've had advisory services such as Live, and like my director said, you get those by sending a request to the facility for assistance. We have capacity building where we train, for instance, just a couple of years ago, we trained 40 members of the Ministry of Finance in Bangui for the Central African Republic on debt, sustainability, and restructuring. Trainings are ongoing. We had a training in Somalia just last week where we trained a couple of officials on MTDS structuring and annual borrowing plans, etc. And building capacity is one of the, if I may say in Latin, foncet origo of the African Legal Support Facility. Ladies and gentlemen, I promise this is the last time you hear me say that because I'm closing. To conclude, permit me to stand back and honor the quiet courage of Africa's debt story. We've moved the needle from sitting on the sidelines and waiting for dictation by more sophisticated lenders to a point where we are now at the table and dictating our own terms as well. From the days of the Paris Club to the EPIC and the MDRI, and now the promise of the G20, we are standing tall as a continent, and we are saying this is also what we want, and this is what we do not want. We must seize this moment, ladies and gentlemen, to ensure that while we press for more fair and effective restructuring frameworks, we are making the most out of the current G20 framework. And you don't have to do that yourself. If you're having concerns as a country with your debt portfolio, the African Legal Support Facility, armed with its very experts on debts, both on the financial and legal side, is here to help every African government represented here. And as we look ahead, Africa must anchor itself first to the lessons of the past, which, as we've learned, prudent borrowing, fiscal discipline. But also we can look at the promise of the future, which is that lenders, wherever they are, whoever they are, can come within the perimeter to discuss an equitable term for the government. And so I leave you with this call, ladies and gentlemen. Let us no longer postpone, reschedule, and just the likes. Let us no longer patch, but let us build a debt architecture within the continent, owing African solutions to African problems. That's our charge, and I hope that we are encouraged in this light. Thank you very much for your time.